You've probably seen the headlines. The wealthiest Americans pay little to no income tax. You may be thinking, wait, what? I'm struggling to figure out how to deduct that $35 Uber ride. Well, as an estate planning lawyer, I help families protect their loved ones and their hard-earned assets. So I've seen firsthand how the rich get away with paying so little in taxes. And today I'm pulling back the curtain on tax strategies that actually work for you. By the end of this video, I'll tell you what you can start doing tonight to lower your taxes. Yes, tonight. But first, let's break down how taxes work and why it's critical to know the difference between pre-tax and post-tax income. Let's start with the basics of taxes. Here's the deal. When you work a 9-to-5 job, you earn what's called pre-tax income. This is the figure the government uses to calculate how much they'll take from you, which, let's be honest, feels like a lot. After taxes, what you're left with is your post-tax income. But here's the kicker. Even if you just saved $7,000 in taxes this year, that could turn into $37,000 in 25 years if you invested it. Imagine turning taxes into, wow, vacation money. So let's get started with the first strategy to lower your taxes. Lower your income. I know this sounds like I'm telling you to quit your job and join a commune, but stick with me, it's not what you think. You need to lower your income strategically. When you're a regular employee, the process goes like this. Get paid, pay taxes, then spend your money. But if you have a side hustle, a small business, or even some freelance gigs, the order flips. Get paid, spend money, then pay taxes. Meaning you get to decide how much of your income is left to tax. I know it sounds bananas. Who in their right mind would want to lower their income? But here's the thing. It's all about lowering taxable income, not actual income. For example, if you earn $100,000 a year and spend $40,000 of that on your business, whether it's new equipment, an online course, or a fancy computer, your taxable income drops to $60,000. And trust me, the IRS is much kinder to you when you earn $60,000 on paper versus $100,000. I started my first business a few years ago while I was also working as a W-2 employee as an attorney for another law firm. So you could call it a side gig. It was a coaching business I had. And my CPA at the time told me I could lower my taxes by buying things for my coaching business. So I did. I bought a camera, software, even a new desk. All of these purchases showed the IRS I had less income to be taxed. Boom, problem solved. Next, step up the game with debt. Wait, what? Now let's take it up a notch and talk about Elon Musk. In 2018, Musk famously paid very little in taxes, despite being one of the richest people on the planet. How? Debt. I know you're thinking, debt is bad, my parents warned me about debt. But Musk, like many of the ultra-wealthy, has a secret weapon. They use debt to their advantage. Here's the mastermind debt trick. Instead of selling off his Tesla shares and paying capital gains taxes, Musk took out loans using his stock as collateral. So how can we do this? Let's say you have $100,000 sitting in your stock portfolio, but you don't want to sell that stock and get hit with taxes. Instead, you put the portfolio up as collateral and borrow $35,000. Now you've got money to spend or invest and you won't owe taxes on it because technically it's a loan. Of course, you'll need to pay interest on the loan, but if your investments are earning more than the interest rate, you're still ahead. This is how Musk keeps his rockets flying high without the rocket high tax bills, and you can too. You may be thinking that's great, but I don't have $100,000 in a stock account. Here's another example using your home equity line of credit, also known as your HELOC. This is a clever strategy that many homeowners use to reduce their taxes while unlocking extra cash, the home equity line of credit. Say you own a home that's worth $400,000 and over the years you've paid off a good chunk of your mortgage, leaving you with $250,000 in equity. Now, instead of selling your home or taking out a high-interest personal loan, you can tap into that equity with a HELOC. Here's how it works. You take out a line of credit against the equity of your home. Let's say you borrow $50,000 from the equity. The beauty of a HELOC is the money that you borrow is not considered taxable income. So while you're sitting on $50,000 in cash, You won't owe any taxes on it because it's technically a loan. Now you can use that $50,000 for whatever you want. Maybe you invest in home renovations, your business, or even in the stock market. Plus, if you use it for home improvements, the interest on the HELOC could even be tax deductible. Next, tax deductions, your new best friend. If the whole debt thing feels too risky and you prefer to sleep soundly at night, here's another trick: tax deductions. For example, the home office tax deduction. I use this for my home office. So for example, say my mortgage is $3,000 a month and my workspace takes up 25%, I can deduct 25% of my mortgage, saving me $750 a month or $9,000 a year. Not bad, right? You can also use this deduction if you rent. In addition to rent or your mortgage payment, you can deduct electricity, business meals, equipment, even that fancy ergonomic chair that you definitely need. Next up, real estate, the gift that keeps on giving. If you own real estate, let's get into some magic. Real estate is like the golden goose of tax strategies. Most people think it's just about property value going up, but there's so much more. For example, rental income might seem taxable, but you can offset it with deductions like mortgage insurance, property taxes, and depreciation. Let's say you rent out a house for $2,000 a month. After deductions like repairs and interest on your mortgage, you're only left with $6,000 in taxable rental income. And here's the best part: you can claim depreciation on the property, which will reduce your taxable income to zero. That leaves us with what you can do tonight to lower taxes. So you're probably wondering, what can I do right now? The downside of many tax strategies is that they take time to fully implement. So here's something you can do right now to start lowering your taxes. Take advantage of tax advantage accounts. These accounts are designed to help reduce your taxable income immediately. First, there's a 401k, a retirement savings plan often offered by your employer. By contributing up to $23,000, you can reduce your taxable income by that amount. Next, the solo 401k is available for those who are self-employed, such as small business owners or freelancers. You can contribute up to $69,000 a year, providing a substantial reduction in taxable income. Third, the traditional IRA, which you can open at any time, and you can contribute up to $7,000 per year. Fourth, the health savings account, which is designed for medical expenses like doctor visits or prescriptions, and you can contribute up to $4,150 to lower your taxable income. Lastly, the 457B plan is available to employees of government agencies and nonprofits and other certain organizations. And those contributions are capped at $23,000. If you are listening and you're a business owner and a parent, and you want to discover a great strategy for lowering your taxes and creating wealth for your kids, watch my video on the 3 secrets to hiring your kids and saving thousands in taxes. We'll link it here.